Hi, welcome to the NLP Summit, and thank you for joining me. My name is Varun, and I have background in building credit risk models and machine learning models for banks and other financial institutions. Today's topic that I have is on generative adversarial networks and Bayesian analysis for incorporating expert opinions into advanced credit risk models. So without further ado, I'll move on to the overview of the slides. I have divided the presentation into essentially 5 parts. In the first part, I'll give an overview of the advanced credit risk models, explaining the landscape of regulatory credit risk models and the key models that financial institutions develop to ensure regulatory compliance and estimate regulatory capital. In the second part, I'll discuss how stress testing is a modeling paradigm in itself, though not completely separate from the standard credit risk models. In the third part, I'll lay down the modeling problem statement, which was one of the key projects that I had led successfully for one of the major Australian banks. In the fourth part, I'll discuss the intricacies of the Bayesian analysis solution that was used to incorporate expert opinions because of paucity of modeling data. Finally, in the fifth part, I'll discuss how generative adversarial networks can help develop a benchmark model, overcoming the lack of modeling data. So moving on to the next slide, broadly speaking, advanced credit risk models are of 3 types: probability of default, PD, loss given default, LGD, and exposure at default, EAD. All 3 models are regulatory driven. That is, the regulators expect financial institutions who have the capability of developing internal models to develop these models and use them to set aside regulatory capital. IRB stands for Internal Ratings-Based Approach, which basically emphasizes that under this approach, the regulators expect major financial institutions to develop their own quantitative models. The plot on the top right is a loss distribution. It is evident that it is skewed towards the right because losses of a higher magnitude happen with a very low probability. This loss distribution is the key to understand the background of developing the IRB capital models. The average value of this distribution is known as the expected losses. In other words, they represent the cost of doing business. A value farther to the right into the tails of the distribution represents the conditional expected losses. In other words, they represent the amount of losses that the financial institution would observe conditional on the economy going through a major economic shock, such as 1 in a 100-year event, 1 in a 1,000-year event, etc. The difference between the EL and the conditional EL is known as the unexpected losses. That is, if we subtract the losses, which are the cost of doing business, from the total losses observed under a major economic shock, we get the unexpected losses. And as the name suggests, these are unexpected. So the financial institution is expected to set aside capital that can absorb such losses. The calculation for EL is a product of PD, LGD, and EAD. On the other hand, the calculation for UL, unexpected losses, is the complicated formula mentioned at the bottom of the slide. Without going into the details of the formula, the key thing to remember in this formula is that the stress economic shock applied is at 99.9% confidence level, which is a 1 in a 1,000-year event. That is, the conditional expected loss is set to a confidence level of 99.9%, and the expected loss is subtracted from it to get the unexpected losses. Now that we have covered the basic background of the IRB models, we will cover some background of stress testing in this slide. Whilst the regulatory capital models estimate unexpected losses from severe events or shocks that may only occur once every 100 or even 1,000 years, they fail to link the loss estimates to a specific macroeconomic projection. Stress testing, on the other hand, links loss estimates to specific scenarios by providing a forward-looking view of risks under stressed economic conditions. That is, under stress testing, the regulators provide special scenarios to the financial institutions and expect them to estimate losses adhering to those scenarios. The special scenarios could comprise shocks on factors that are closely linked to the economy and negatively impact the key macroeconomic variables such as GDP, inflation, interest rates, etc. The objective of the stress testing models is to estimate or project PDs or LGDs adhering to those scenario projections. There are the following two statistical approaches that are used to develop such models. One is vector autoregression approach, and the other is copulas. On the bottom left, we see the mathematical description of the VAR models. There are three dependent variables, GDP, unemployment, and HPI. And the idea behind a VAR model is to model these variables using lags of the same variables. Once such a VAR model is developed, the next step is to create the distributions of the underlying metric under thousands of possible regressions of macroeconomic variables and estimate the distribution statistics from them. Each simulation would determine a new path for the economic outlook, and each economic outlook could be used to predict the potential value of the underlying metric, such as the probability of default. The second statistical approach used for stress testing purposes is copulas. A mathematical copula is a joint probability distribution that induces a specified correlation structure among independent marginal distributions. In the equations mentioned on the middle right, we are inducing a correlation structure between the observed default rates, represented by Z log of ODR, and a macroeconomic variable such as unemployment, represented by Z unemployment, and a random Gaussian variable represented by Z2. For simplicity, the random error is assumed to be constant epsilon, and the correlation coefficient rho is the empirical correlation coefficient. The next step is to estimate the constant epsilon using observed time series of the observed default rates and unemployment. Now that we have covered some background of both the IRB models and stress testing, we will discuss the background of the modeling problem statement in this slide. The plot on the left shows the ever-rising trend in the housing prices in Australia, especially in the key markets such as Sydney and Melbourne. This is because of different macroeconomic factors such as increase in immigration, increase in property development, etc. But it is also because of the credit lending policies by the major banks. An investor can borrow a mortgaged loan, investing into 3 to 5 properties at one time. Due to these reasons, Australian Prudential Regulatory Authority, APRA, believes that there's a systemic risk in the housing property market in Australia. And this is a cause of major concern because if the housing bubble bursts, then it can cause major financial trouble to the big banks. The plot on the right shows that Australia hasn't really seen a recession for 27 years. This means that there are no two consecutive cycles of negative GDP growth, implying that there is no data which can help us getting an indication of the potential property market burst or a major economic slowdown or downturn. This brings us to the next slide, where we will define the modeling outcome loss given default and formalize the problem statement, connecting it to the data challenge discussed in the previous slide. The flowchart at the top describes the several stages of the default and the recovery process. It is to be understood as follows. When a residential mortgage borrower defaults, there are several next steps or pathways to it. It can happen that the borrower's financial health improves and he pays back the credit due. This stage is known as cure. We call that the borrower account has cured. It can also happen that the property is under foreclosure, where the bank interferes and puts the property on sale, or the customer takes the next steps and puts the property on sale himself. Once the due pathway is determined, a haircut is applied to the property price. The haircut represents the estimate of the difference between the expected value of the property sale and the actual value of the property sale. Once that is done, the final sale amount represents the recovery amount after adjusting for costs spent on the collections and property sale, and is adjusted for time value of money, bringing it back to the point of the original default. This brings us to the formal definition of loss given default, which is 1 minus the recovery amount divided by exposure at default. In other words, it represents the proportion of the exposure at the time of default that the bank expects to lose in case of a default. At the bottom, we revisit the IRB formula, which we saw earlier. Here, we note that the LGD in the formula represents the downturn LGD. The reason a downturn LGD value is expected in the formula is because the probability of default is already stressed via a 1 in a 1,000-year event. So for the sake of simplicity, LGD is not stressed via a mathematical expression, but is replaced by an estimate of itself in a downturn. This brings us to defining the problem statement again. We want to estimate the value of loss given default, LGD, for residential mortgages in a downturn. Another key fact that needs to be mentioned here is that prior to developing this model, the regulator APRA provided a flat floor value of 20% to be used for the downturn LGD. However, now they gave all financial institutions a chance to estimate the downturn LGD more accurately by developing a model. The key benefit to the bank is that if they can reduce the average downturn LGD below 20%, they will end up saving a lot of dollar amount in regulatory capital, which they are setting aside currently. Now, summarizing the previous slide and this slide, we understand that we need to develop an LGD model for downturn, but we don't have the underlying downturn data because Australian economy hasn't witnessed a downturn event in the past many years. This brings us to the solution we use to overcome the problem of the lack of macroeconomic data, which is Bayesian analysis. Before going into the depth of the solutions, we'll cover the basics of it. Bayesian analysis has three key attributes: posterior, likelihood, and prior. In this formula, theta represents the parameter whose value we want to estimate. Under Bayesian philosophy, the parameter is a distribution and not just a single value. D here represents the observed modeling data. So the probability of data given theta is the usual likelihood which we are familiar with under the frequentist paradigm. The probability of theta, p theta, represents the prior. These are the prior beliefs around the parameter theta. For instance, this can be guided by domain knowledge of the experts or expert opinions. The probability of theta given data represents the posterior. The Bayesian way helps us to incorporate the prior, that is expert opinions, along with the likelihood, that is observed data, and model a posterior view of the underlying model parameters. Note that the probability of data is just a normalizing constant, also known as the evidence. Now we'll move on to discussing how Bayesian analysis was used to model downturn LGD. The schematic on this slide provides an overview of the Bayesian analysis solution. On the top, we have the non-downturn data. This is the data that is observed historically but represents benign economic conditions. This goes as the likelihood P data given theta in the solution. On the bottom, we have the downturn data. These are the expert opinions about the downturn. As mentioned earlier, since there is no downturn data for modeling, we use expert opinions as a prior in the Bayesian solution. Now, who are these experts? The experts here are different stakeholders or teams that are involved in the credit risk management process of residential mortgage borrowers. So they could be people from the collections teams, group economics, portfolio managers, etc. The idea is to extract their views on the definition of a downturn and how would a downturn impact the mortgage losses and recoveries. Once we have such expert opinions, we convert them into mathematical expressions such that they could be used into the Bayesian analysis solution. Then the two key elements, the prior and the likelihood, are combined to create a posterior distribution. The next step is to sample from the posterior distribution such that we can estimate the parameters which will work for the downturn event. The sampling can't be performed directly from the posterior distribution because it is very complex and intractable, meaning it can't be solved using conventional mathematical methods. Therefore, Markov Chain Monte Carlo techniques are used instead. After performing the Markov Chain Monte Carlo, the MCMC sampling, we get a downturn probability of a cure or a foreclosure. This is the same pathway which we discussed earlier in our slides. That is, post the default event, the property could be subjected to a foreclosure or even get cured. This slide and the next two slides offer a deep dive into the Bayesian solution. This slide provides an overview of how the expert opinions were converted to actual values used mathematically as a prior information. The plot on the top right represents the relationship between the foreclosure rates or cure rates and a variable named var, which is believed to be a strong driver of those rates. The circles represent the actual values of the foreclosure rates with respect to the corresponding var values. The gray line, normal, represents the line which we can fit through those actual values using least squares. Since we are fitting a line through the actual values which comprise a benign economic environment, we call them normal. The red line, downturn, represents the line which we fit using the expert opinion information using constrained least squares. As you can see, the red line gradually starts increasing and then takes a quadratic shape at the end of the var values. This is a feature we expect in a downturn. That is, we expect when downturn occurs, the foreclosure rates would be significantly higher for larger values of var. The bottom part of the slide provides the mathematical description of how the red line is fit using constrained least squares. The vector x comprises the value of var and the squared values of var. This is because we wish to fit a quadratic polynomial to achieve the shape of the red line discussed earlier. So we use a squared value of var as one of the independent variables. The vector beta is the parameter vector where each value of beta represents the corresponding coefficient of the quadratic polynomial term. The term on the bottom right is the downturn constraint. The expression x transpose beta gives the foreclosure rate for the ith value of the variable var. We take the average of all those foreclosure rates for n such values and assign it to a constant c. This constant c is the expert opinion on the foreclosure rates in downturn. Therefore, this expression represents our downturn constraint. Thus, we modify the standard least squares optimization by adding the downturn constraint and estimate the beta parameters using that. Thus, though the red line in the above plot, we are able to convert the expert opinions into specific values that we will use as prior information in the Bayesian analysis solution. The next two slides discuss the Markov Chain Monte Carlo sampling techniques. The plots represent a hypothetical CDF and PDF of a random variable. The objective is to sample a value of the random variable from its PDF. The standard process to do this is known as inverse transform sampling. On the plot, we can see that we have a variable u which lies between 0 and 1. This is the random variable following the uniform distribution. For the value of u, we can always use the inverse of the CDF to get the CDF inverse u. Inverse transform sampling says that for a variable u randomly sampled from a uniform distribution, the inverse of the CDF at u will give the value of the random variable that will be set to be randomly sampled from its probability distribution. The algorithm for inverse transform sampling of a normal distribution is mentioned on the right. We randomly sample a value u from uniform distribution. Then we use the CDF inverse of a normal distribution using the value of u as input. The value we get is x, which will be randomly sampled from the normal distribution itself. One modification to the algorithm has been added below, which is that x is bounded between a and b. This is when we want to randomly sample from a truncated normal distribution whose values are truncated between the interval a, b. However, this methodology does not work when we want to sample, say, 10 standard deviations away from the mean of the normal distribution. Since the probability of finding such a sample randomly is really low, a large number of samples are needed to be sure of getting one such sample. Therefore, inverse transform sampling fails in that case. Which brings us to the next slide, which discusses an alternative solution known as accept-reject sampling. Accept reject sampling works for the downturn model because the conditions used by the definition of downturn were extreme. Therefore, it led to generating samples which are many standard deviations from the mean. Under accept reject sampling, instead of sampling from the original distribution, we sample from a proposal distribution. Consider P of x to be the target distribution, which we want to sample from, and Q of x to be the proposal distribution, which we will use to sample from. We have an additional condition, C into Qx should be greater than or equal to P of x, which basically means that the proposal distribution should cover the entire range or support of the target distribution. Then we draw two samples, one from the proposal distribution known as Z, and the other from a uniform distribution known as U. We take the ratio P of Z over QC times Q of Z, and then compare it with the value of U. If U is less than or equal to that ratio, we accept it, else we reject the sample Z. Therefore, what we are really doing is accepting and rejecting samples from the target distribution probabilistically. It can be proved that such samples Z or X are supposed to be drawn randomly from the target distribution itself. The bottom part of this slide shows some examples of different proposal distributions where the target distribution is normal. As we increase the value of X, which is the value we want to sample from the normal distribution, many standard deviations away from the mean, we see that the proposal distributions begin to look really similar to each other and to the target distribution as well. The final slide discusses the application of generative adversarial networks, or GANs, to build a comparative benchmark model. The idea behind this model is that we have EL equals PD times LGD times EAD. We can substitute a stressed value or downturn value of PD equals 3%, which is really high for a residential mortgage portfolio and reasonable to expect in a downturn. Then if we have actual losses from the stress times represented as EL on that portfolio, we can get an estimate of downturn LGD from that. The plot here describes the loss distribution, which we see that is right skewed. The green points represent the actual loss data that is internal to the bank. As expected, this data is from the benign economic time period and also fewer in number. The blue points represent the loss data that is external to the bank, but from stressed times. That is, we source external loss data from different financial institutions from other economies, which we believe are similar to the loss experience for our financial institution. This is done to add more data points to the tail of the loss distribution. The next step is to train a GAN to generate synthetic data points to enhance or enrich the tail of the loss distribution. The underlying idea is that we need a measure of value at risk. That is, we need to estimate loss values from the tail of the distribution, which are above 95th percentile or 99th percentile. And if we don't have enough data points, we cannot do that with accuracy because the distribution is heavily skewed to the right. The algorithm is mentioned on the right-hand side. We divide the actual data, both internal and external, into development and validation data sets. Then we train a modified version of GAN, which helps us to generate more samples on the fence or the boundary or the tail of the distribution. Then the trained GAN helps to generate more synthetic data points. Thereafter, a kernel density function is fit to the generated samples, which helps us to evaluate the log likelihood of the validation data. This ensures that the GAN model is also working on the unseen validation data. Thereafter, the fit is improved to maximize the log likelihood of the validation data set. Conclusively, once we have the loss distribution which meets the standards of accuracy, we can estimate the higher loss percentiles from that and get an estimate of the downturn LGD. This concludes the presentation. Thank you all for joining me. I hope you enjoyed this presentation, and if you have any questions, please feel free to ask them in the chat box. Thank you.